Hey, welcome to Loonie Tree. Today we're talking about an investment strategy that gets associated with one of the most successful investors of all time. And the best part about this strategy is how easy it is to execute. First and foremost, this is not a get-rich-quick scheme. Advice like that is rarely good. But this advice, in our opinion, is one of the best ways that an individual can get started investing. It's simple to execute, it doesn't take much time, and it's proven to perform. At its core, the strategy is really based on two principles. First, it's just hard to pick stocks. Choosing individual stocks that win is difficult, even for the pros. And second, fees, like trading fees and management fees, over time, can really hurt your investment returns. Now, there's a really cool story that goes along with this strategy. In this case, the story revolves around a bet. See, in 2007, Warren Buffett, one of the most successful investors in the world, made a bet with a group of hedge fund managers. He wagered that over a 10-year period, a low-cost index fund would outperform a collection of hedge funds after accounting for fees and expenses. That probably sounds like a bunch of financial lingo, and it is. But there are basically only two terms you need to know for this story. The first is, what is an index fund, or an ETF? That was Buffett's pick. And the second is, what is a hedge fund? Now, if you want to know more, you can check out our 1-minute videos on these subjects. But in case you haven't had a chance yet, we'll do a quick run through. So what is an index fund? Well, an index fund is a type of mutual fund, or ETF, that is designed to track the performance of a specific market index, such as the S&P 500 or the Dow Jones Industrial Average. Now, these market indexes are really set up to represent an economy or a specific sector of an economy. To do that, the indexes are made up of a whole bunch of stocks. For the S&P 500, it's 500 stocks. Now, you could invest in every stock on that index, but you would need a lot of money and you'd have to make a lot of purchases. What an index fund does is it looks at these indexes and invests in the same stocks or securities that make up the index and in the same proportion. So the index fund or the ETF really just bundles these stocks up, and with one purchase, you can buy one share of the index fund, and it represents a fraction of each stock in the index, which means you've basically bought exposure to all 500 stocks, but for much less money. As you might guess, ETFs and index funds are popular with passive investors who prefer a hands-off approach. Hedge funds, on the flip side, are very different. Hedge funds are investment partnerships that use pooled funds from typically high net worth investors. When they do this, they often employ what are quite advanced investment strategies, and they're managed by experienced investment professionals. These professionals aim to generate higher returns by taking on higher risk than traditional funds. They typically charge high fees, including a management fee and a performance fee, which is a percentage of the profit made by the fund. Hedge funds usually market themselves as being the best investment specialists getting paid by you to pick the best investments. Back to the bet between Warren Buffett and the hedge funds. The bet ended in December 2017, and Buffett emerged as the clear winner. The index fund that he selected, the Vanguard 500 Index Fund Admiral Shares, outperformed every hedge fund and actually produced a return that was over 3 times better than the average hedge fund. So why did the index fund or the ETF strategy win? Well, for 2 reasons. First, it's hard to pick stocks, even for professionals. Buffett was betting that the whole market would perform better than an expert's collection of individual stocks. And second, index funds and ETFs don't have the same fees as hedge funds. Over the long term, Buffett felt that the low fees to buy ETFs or index funds gave him a big advantage here. Now you might be saying to yourself, this is so easy and it's proven, why doesn't everyone do this? And I think there's 3 reasons for this. 1, investing can be intimidating. So instead of doing the research, a lot of people seek professional help first. Professionals are a great resource, but unfortunately, they're not always going to be incentivized to help you develop investment knowledge. On top of that, what unfortunately seems to be the case is no one really wants to get rich slowly. It leads us to our third point. People usually want to speculate rather than invest. They want that big hit, that 10 bagger, This really isn't a good expectation. And because of that, people gamble on stocks that they may not understand and take chances that can sometimes lead to great rewards, but more often than not, lead to them losing money. Especially for the beginner investor, safe, stable investments over the long term often outpace a collection of risky ones. Now, one thing to remember here is that the index fund was not winning every single year. Again, this strategy is not a get-rich-quick scheme. Every year there will be stocks that do better than the strategy. What I think the most important takeaway here is that if you are investing over a long period of time, there's a very simple strategy that you can take to perform really well, especially if you don't want to worry about trying to pick the right stocks. Professionals, such as the ones that work at hedge funds, can be great, and they can tailor portfolios to exactly what your financial needs are. But for those who are just starting out and want real-life exposure trading in the market, this is a great strategy to do that. And on top of that, it's been proven to beat professionals in the past. At Loonie Tree, we are huge believers in ETFs, especially for new and early investors who have a long-term outlook. Want to know more about how to pick an ETF? Stay tuned to the Loonie Tree channel. As always, thanks for watching, and let us know in the comments what you think or if you have any questions. Until next time, remember, financial success is about progress, not perfection. Start small and stay consistent. Bye for now.